Imagine a finely tuned engine driving your household's entire lifestyle: rent, groceries, school fees. Now imagine the primary earner passes away, and that engine stops cold. Every incoming dollar vanishes overnight, but the expenses keep running. The strict operational purpose of life insurance is to replace that lost future income. Because of that, setting up this safety net should precede any other investment you make. To give a family enough runway to reach self-sufficiency, a policy must replace your income for at least 10 to 20 years. This requires a payout totaling 10 to 20 times your current annual salary. Life insurance is a defensive shield. It is not an offensive wealth-building tool. Grasping the distinction between protecting your money and growing your money is the only way to buy insurance correctly. If you are in your 20s or 30s, there is a major mental block to buying a policy. You look at a 40-year term, and you realize, if I survive, I pay premiums for decades and get zero financial return at the end. It feels like a total waste of cash. The insurance industry knows exactly how much you hate the idea of wasting money, so they heavily market what are called money-back or endowment plans to soothe that exact fear. The pitch is highly appealing. Pay your premiums, and if you live to retirement, we give all your money back. If you die, your family gets the death benefit. It sounds like you cannot lose. We need to test that promise. By running the numbers, we can mathematically prove why separating your insurance cover from your investment portfolio is the only effective way to protect your family. Chasing a return on your premium out of the fear of wasting money creates a devastating compromise. It leaves your family underprotected and severely limits your own financial growth. Let's start with the baseline: pure term insurance. It is a straightforward, ruthless contract. You pay a very low premium to buy a significant death benefit, but you yield absolutely zero money if you survive the term. Look at this chart. Paying a flat 10,000 rupees a year across 40 years secures a one-core payout. But watch what happens. The dollar amount stays the same, but inflation eats its purchasing power. By year 30, the real cost is a tiny fraction. Plus, your premium payments are legally deductible. You pay an increasingly cheap premium and lower your tax burden in the process. A term plan offering zero return is actually its greatest feature. Since the insurer doesn't owe you money back, they don't have to invest it. That frees them to offer you high-risk coverage for pennies on the dollar. Now we apply those exact same coverage metrics to an endowment or return of premium plan. This matrix reveals the true cost. Pure term gets a substantial cover block for a tiny premium. But securing that exact coverage through an endowment plan requires a premium block 3 to 4 times larger just to get that tiny return block back. The cost skyrockets because of a structural flaw. When you demand your money back, you force the insurance company to act as your wealth manager. That is a job they are not optimized to perform. The opportunity cost is significant. If you bought cheap term and invested that extra money into the market yourself, you'd get vastly higher compound returns. Buying an endowment plan leaves you paying premium prices for a subpar investment yield. Worse, because premiums are so high, most people buy less coverage than they need, leaving their family completely underinsured. There is a valid critique. A death benefit doesn't help if you survive a catastrophe but lose the ability to earn an income. The solution is riders. These are modular, highly targeted add-ons you attach to your base policy to protect you while you are still alive. Check out how this works. Start with a base term policy, then snap on a critical illness rider. This triggers a lump sum payout for medical bills. Next, an accidental disability rider replaces lost income. Finally, a premium waiver drops your annual cost to zero. Spending a fraction more on these specific riders transforms a simple death benefit into a multi-layered income protection plan that supports you while you recover. Optimizing your policy on paper means absolutely nothing if the insurance company legally denies the payout the moment your family actually files a claim. This introduces a non-negotiable metric, the Claim Settlement Ratio, or CSR. It tracks the exact percentage of claims an insurer actually honors and pays out. But even with a high CSR, the number one reason claims are rejected comes down to the applicant. Specifically, their failure to disclose pre-existing medical conditions or lifestyle habits when signing up. You have to be brutally honest on your application. If you smoke, drink, or had a past illness, declare it. Lying to save a few dollars a month gives the insurer a legal trapdoor. It guarantees your family will face an exhausting legal and financial struggle at the exact moment they are most vulnerable. Now that you know exactly what to buy, the only thing left is when to execute the strategy. This quadrant chart maps age against premium cost. Ages 25 to 35 form an absolute lock-in zone. Here, mortality risk is at its statistical lowest, meaning your financial leverage is at its peak. Look at the math of waiting. Delaying until 45 drastically escalates lifetime cost. Health risks naturally increase, and the exact same coverage costs fourfold. If you are young, you might hesitate to buy insurance before you even have a family to protect. But buying now is the only way to lock in an impossibly cheap, permanent rate that lasts for the next 40 years. You cannot time the market with human biology. Securing pure coverage at the earliest point of steady income gives you high leverage. Here is the final buyer's scorecard to take to the marketplace. First, buy pure term insurance only. Reject any investment or return of premium gimmicks entirely. Second, target a coverage volume between 10 and 20 times your current annual income. Third and fourth, mandate critical illness and disability riders to protect yourself while alive. Verify the insurer has a claims settlement ratio above 95% and disclose your medical history with total transparency. Secure your family's safety with a low-cost pure term plan, then use the significant savings to aggressively build your wealth through actual investment products.